Many of you work at US tech companies, and a large part of your compensation comes in the form of stock units. If you're confused whether to continue to hold on to your beloved stock units or to diversify them into, say, a NASDAQ 100 or a UCIT of your choice, then you will find today's video helpful. For those of you who are new to the channel, I am Pranay. I work at Google myself, and I've worked there for the last 8 years. And this is a question that I have tried to answer for myself. And so I'm going to be sharing my thoughts and learnings with you. And so hopefully you find this video helpful. Watch it till the end.
This channel is brought to you by the 01 Media Network by Zerodha. With their support, I'll be helping you spend your money wisely.
The video is going to be broken down into 3 broad sections. Section number 1 is going to be all about behavioral economics. Most people at work that I meet have actually not sold their stock, and they continue to hold it and accumulate it, which has worked out well for some of them, but for some of them who are in other companies, it has not worked out so well. And so in this first section, I want to call out all of the different biases that are making sure that you don't sell your stock. I'm not saying go sell it, but I'm saying just be aware of the biases. If you read this book, Predictably Irrational by Dan Ariely, then you will probably relate to some of these biases. But I just want to put it in the context of how those biases are working when it comes to you holding onto your stock. Section number 2 is going to be cold hard data. What we have done is we're not just going to look at the past track record of these companies, but we have actually built a simulation. And what we've done is we've taken the trajectory of a person who works at any of these big tech companies for the last, say, 9 years. And we've charted out 2 scenarios. Scenario number 1 is where this person has held on to their stock. And scenario number 2 is that as the stock vested, they just diversified it into a NASDAQ or a S&P 500 ETF. And at the end of both the scenarios, how much money do they have today? We've accounted for refresher grants, we've accounted for joining grant, we've accounted for promotions, and we've accounted for all of this stuff. So stay tuned in section 2. In this section, I will be joined by Vatsal from The Financialist, who was earlier on the channel in the Global Investing Masterclass. Him and I have built the simulator together, so you will find value there. And section number 3 is going to be around, if you must think about concentration, what are the frameworks around it which you can take into account, and how can you think about it? I'm not averse to concentration. I do agree that it helps build wealth, but how can you think about it in a more systematic way and not let inaction decide concentration, right? With that, let's jump in. I hope you stick around till the end, and if you like the video, please consider subscribing to the channel and drop a comment. It makes all the difference to the algo. I'm trying to get to 100k subscribers, and so hopefully you can help me get there. Let's jump into section 1. So assume that instead of your current compensation package, your current employer, say Amazon in this case, gives you your entire salary in the form of cash, cold hard cash, right? No variable and no stock, just cash. Would you actively take 30% of that cash and go buy Amazon stock with it every month for the next 8 years? Would you actively do that? A large majority of people will say no, right? And so then why is it that most people actually end up doing that? Because that is exactly what you're doing. You get 30% broadly of your compensation as stock unit, but you are continuing to hold it. While if you had to take an active decision, you would not do the same. Why is that happening? There are 3 biases because of which this is happening, right? So the first one is the inaction trap. Now, most people around me at work end up not selling the stock, end up doing nothing with it, and they are thinking they are doing nothing and so on. This is what inaction is. Why is that inaction? Because selling requires you to do a lot of things. There is a lot of cognitive overload there. You have to first think of, how do I log in? How do I see my shares? What buttons do I click on to actually sell? Then you have to think of the tax implications. What taxes am I going to pay if I sell it? Third, you have to think of, what if I sell it now and the prices fall? Should I have sold more? Or what if I sell it and the prices go up? Will I look like a fool? And so there is a lot of active thinking that is going on in your mind before you actually press that sell button. As a result of which, you do nothing. You sit back and you're like, I'm not going to do anything with this money. Let it go. Whatever happens, happens. But by not selling, what you have actually done is you have shown a very strong positive commitment in concentrating your wealth in that company stock. So while you're thinking you're doing nothing, you are actually concentrating passively in your company stock, which I don't think is the right thing to do, because honestly, if you are that bullish about the company, then remember the example I gave you earlier where you get the entire salary in cash. You should be taking 30% of that and buying hand over fist the company, the stock of your company that you're working at. If you are not that convinced, then this is not what you should be doing, is my simple point around this inaction trap that you're probably falling into. The tax argument also doesn't really apply here, because what ends up happening is that the minute your stock vests, if you sell it right there and then, there is no capital gain tax on it, because the difference between the selling price and the vesting price is the same. There is no difference, and therefore there is no capital gain tax that you have to pay. So the tax argument also doesn't apply here. Next, let's move on to the second bias, which is called the endowment effect. Now, in simple terms, the endowment effect means that you give a subjective premium to the things that you personally own. So, for example, if you're in the market to sell your old car, we talk a lot about cars on this channel, right? If you're in the market to sell your old car, you traditionally will give it a higher value than what the market is willing to pay you. And that is exactly the endowment effect in place. Why are you giving it a higher value? You think it's amazing. You think that I've maintained it so well. There are no scratches on it. The paint is also amazing. I have such good memories. I'm a great car owner. I take care of my car and so on. And that's why you marketed a premium, but nobody's buying it from you at that price. The same can happen with your company shares as well. You could actually be giving them a subjective premium because you work at that company. You feel that you have worked so hard to earn these shares and therefore they are worth a lot more. You believe that you know a lot about the company and you're bullish on the company and that's why you work there and so on. And all of these different stories that you have cooked up in your mind, which is basically what endowment effect is, which is why you are pricing these shares slightly higher than what they really are or how the market is pricing them. And so be mindful about the endowment effect also on why you're probably holding on to these shares. The third bias, and statistically the most dangerous bias, is the survivorship bias. Now, what is survivorship bias? There are a lot of stories around that, hey, there was this one person who joined a company at a very young journey of that company and they got stocks in that company and now look at them, they've become millionaires and they've retired for life and they have so much money and so on. For every such story, there are hundreds of other companies where their employees did not make any money by holding onto their stock. Be it an Intel, be it a Yahoo, be it a Sun Microsystem, be it a Peloton, be it a Snapchat, I can go on, right? So for every Nvidia, there are so many others out there who have not made money. And there's actually collective destruction of wealth that has happened over a period of time post IPO. And so what I'm trying to say is that do not base a strategy or do not base a decision looking at the outliers who have generated a lot of wealth for their employees and actually also looking at all of the others who have not, because that's when the true picture comes out and that's when you're able to take a more balanced decision and not a decision in isolation, hoping against all odds or like almost playing a lottery that my company is going to be the next Nvidia and therefore I'm willing to bet the house on this, because that's not the financially prudent or the responsible thing to do. And so be sure that you read up a little bit about survivorship bias, because there is a high chance that there is some survivorship bias that is playing into your decision making. Okay, now let's move on to the next section where I am going to be joined by Vatsal and we'll go into cold hard data, because I know my audience is very smart. They'll be like, we know about these biases, but show us the data. And so now we are going to do a simulation. Vatsal and I are going to walk you through it. So let's jump into that. All right, we are going to be looking at a calculator, a RSU calculator, which is going to help you show that if you were to leave your stocks in your company that you work at over a long period of time, what the returns are like. It's a real-time projection that we've done using the past data. And if you were to instead invest it in a QQQ or a NASDAQ index, how much would the returns be? And whether the concentration was actually worth it. Whether it was worth keeping the stocks, taking that concentrated risk in that particular company, or whether the returns were actually not worth it. In this section, I'm joined by Vatsal. Vatsal is the co-founder and chief investment officer at The Financialist. He's also been on the channel once before in the Global Investing Masterclass. You can go check it out here if you haven't seen it before. But Vatsal has actually helped me build this calculator, and together we are going to now walk you through how that looks. So with that, Vatsal, welcome to the channel again.
Hey Brian, thanks for having me. Really excited to show our audience.
Let's jump in. So while Vatsal's pulling it up, we are going to be showing you the Google projection, how that looks over a 9-year period, Vatsal. And then we'll also show you some other charts on how that holds up for other companies.
Yeah, that's true. For some basic details, right? So we have, these are the input sheets where we'll need to put some data. So we are currently concerned with someone at Google. Say every time the shares vest, there's a 35% withholding for, or quantity gets sold only to cover for the tax. And say we'll compare it with WU, which is the S&P 500, and QQQ, which is the NASDAQ 100. Right now, let's say that hypothetically, this is where you have to put all your grant details. Now, this grant details will change from person to person. Whenever you have gotten grants, just put it here. Now, there are typically 3 different kind of grants that you get. One is when you join the company, and that's typically your largest chunk. A good percentage of CTC is via the RSUs component. Then you keep getting refresher grants, and say if in middle of the entire journey at the company, if you get promoted, you get some promotion grants. So you've done like a simulation where say someone who when they joined Google, they got like a $30,000 worth of grant. Then they keep getting refresher grants. Again on promotion, they got a bigger chunk, and every time a grant is given, you get put your vesting clauses, right? So first vesting could be after 1 month, after 12 months, after 6 months. And once the first vesting is done, at what intervals does it keep getting vested again? So for some company, it could be first vesting after 12 months, and then every quarter it keeps changing. So you can just put your data over here and look at what the data tells you eventually.
And even like there are cases where they are front loaded. So your vesting will happen more in the first few years, and then later on it will happen in a different way. So you can use that vesting frequency and you can change that accordingly.
Correct. So depending on each grant, the clauses could be different. So you can keep it according to this grant itself.
Yeah.
Now, here is the interesting part. So, if someone would have, just held on to Google for the last 8 years, they would have seen like no meaningful difference. All right. And in the last 6 months, because, Google share price has shot up, it's like there's like a 54% difference in the total value of Google that you would have had. This is the real difference we wanted to show today, that holding versus diversification doesn't really add much alpha. But obviously, if you look at it on a particular cutoff time, and at that cutoff time, last 6 months, last 3 months, the share would have done better, then there'll be a spike. But otherwise, it was no rocket science in the sense that whether you had Google or whether you had, sold Google, and on each vesting, if you had sold Google and just bought QQQ or Woo, what your value would have. It's pretty much straight.
In fact, I'm also thinking that we should have a drawdown chart against the same. So if we were to look at the drawdowns that this concentrated bet would have faced, we can do that later. But like what I'm trying to get to is that you were so concentrated in a particular stock, your drawdowns would have been a lot more compared to what QQQ or Woo would have seen.
Correct.
Whereas the returns are pretty much like evened out.
Yeah, the drawdowns basically will become part of this line graph only. It's just that the last move is such huge that you'll not able to see it. But say if I were to put this, say if I remove the last entire 6 months out of the equation, right? Then look at this. Yes.
Yeah.
So if you now see, the drawdown is like slightly more clearly visible. But again, that drawdown has been in sync with QQQ. Like it's not like, only Google fell and nothing else fell. That happened with Meta once, that, Meta crashed like 70% when QQQ crashed only 30%.
When Mark was going crazy with the whole metaverse investments, investing $10 billion a year.
Yeah. It's again, AI may be way over, but.
Yeah. Okay. So net, sorry, on the Google stock, concluding in the last 6 months, it's obviously outperformed a lot and it's gone up by there's a delta of 54% compared to Woo and QQQ. But let's look at some other stocks as well. Which one do you want to start with? I know we have 4. We have Amazon, we have Oracle, we have the king of them all, Nvidia, just to show you what crazy outperformance looks like. And we've already covered Google. So yeah.
CRM.
And we have Salesforce. Okay. Yeah, great. Let's go one by one. Oh, wow. We're starting with the big one.
Yeah, the Amazon one. We are starting with the Nvidia. Sorry. Yeah. So if you look at the Nvidia, crazy up move, like you would have been like 700% times more better off just holding it. But you realize this only in the last 4 years. Like in the first 4 years, like the last 4 years, the line is outperforming to such an extent that you can't even meaningfully see what's happening in 2016 to 2020. But yeah, the difference in value between holding and diversifying into QQQ wasn't visible until 2020. Honestly, it wasn't visible for even someone who would have been there for last 10 years. But this is the crazy amount of alpha it is given. But it also shows you one thing, right? That probably this is a good time to cash in, even for Google. Like if everything was supposed to mean revert and the industry has to grow in sync with each other, right? If you see the recent news, right? Anyway, Google is being like an Nvidia competitor in recent date, and that's the reason for outperformance. So things must, like no one can earn supernormal profit for the rest of their lives.
Correct.
So probably this is a place where you cash out and don't anchor yourself. Nvidia made a $200 top, I will not sell it at $180. It still made like such a huge difference. Let me now change the screen to.
I like what you said about regression to the mean. Eventually, if you study this over a long period of time, everything will regress to the mean. And so if you are way ahead of the mean, know that it's not a bad time to cash in.
Next is CRM for us, which is Salesforce.
Salesforce. A lot of Salesforce employees in India who are hopefully watching this video and not feeling too bad, or who have actually diversified.
Yeah, I mean, we've had case studies where just because you're getting stock at 15% discount, you do the ESPP, is the stock purchase plan, and they don't even sell that. It's like, if there was no ESPP, would you have bought like so much of Salesforce, right? No, not really. So we really like ESPPs in the sense like a short gain, but like exiting the day you get vested, right? You're just trying to make some guaranteed profits, but no point adding to your value. So this is what, like, you'll, as a particular cutoff point, you will always have some outliers and, some stocks performing like this. The better thing would have been to just diversify and, just be happy and not leave things to luck. Right.
So this is an underperformance case. You can see the blue line, which is the CRM line, which is below both QQQ and S&P 500. There is a percentage difference of minus 45% over this 9-year run, 80 or 9-year run. So yeah, CRM hasn't really worked out well. One, you have taken so much risk of concentrating it in CRM stock, and even that hasn't paid off really. Sorry, CRM stockholders, trigger warning. Moving on.
Now we'll move on to Amazon. So Amazon has been kind of a mixed bag, sometimes outperforming, sometimes underperforming. But if you look at this line, right, difference between holding and diversifying, like this is the perfect view of it in the sense that as on what cutoff point you are better off in Amazon and as on what cutoff point you are in like not better off. So this chart like explains like both sides of the journey. Like, you know, if you would have done this and if you were doing this video in 2021, like we are seeing Nvidia right now, you would have seen Amazon in 2021 saying that, oh, it's in such glory days, I was so better off holding Amazon, right? But
Yeah.
it can quickly revert to mean like this is like, you know, this is going down now. So overall difference as on today would have been 11%, but to each its own use case, some people would have left Amazon before, so they would have not gotten any refresher grants at this point, right? And they would just be holding their old grants, and for that, you know, they will be in like steeper losses because they never got the average down reduced grants. And like from what I know with Amazon folks also, right, the amounts of grants they get, they also kind of keep getting adjusted. Like Amazon keeps like a target price in mind, and according to that target price, they give less quantity in the years when the stocks are doing well. So, you know, eventually all evens out that, you know, if Amazon basically crashes by 50%, Amazon thinks that, okay, my fair market value is this much, so, you know, I'll to give you less quantity only. So you don't really make like a huge benefit in the down years because they are like, okay, even if the stock is trading at $100, our market value is $150. So if it reaches $150 someday, you'll basically stand to make a lot. So we'll give you lesser quantities only. So they're not like a percentage of CTZ kind of company. You know,
I didn't know that. Interesting. That's not good.
And if Amazon outperforms its own target, then the next year also your grants gets adjusted. Like they typically end to give you lower, saying that you already made so much money by.
So both ways you're screwed.
So they're kind of treated like cash salary only. It's just that they're paying in terms of stocks. But yeah, the narrative that, you know, it's super important for people to understand, right? That you know, depending on case to case, this may or may not be surplus part of your wealth. Surplus in the sense, even if this was to go to zero, you know, you would not mind because, you know, you'd have money lying elsewhere to meet all your financial goals and stuff. So what becomes an important diversification first step is know how much you need to ensure that all your goals are met. Now, say if you're holding, say 500k worth of RSUs and the answer is you need 300k worth of money to make sure all your goals are in sync and, you know, you don't end up like losing out on your entire financial planning journey. At least sell 300k worth of them and diversify it. Diversify in QQQ, diversify in Indian markets, do whatever you want to do. And then on the remaining 200k, you can choose to retain it as a concentrated bet. But again, there you can just think objectively, do I want to retain it as a concentrated bet in the company that I work? I could have taken a concentration bet in Nvidia also while I'm working at Amazon.
Yeah.
Why be so fixated on taking the concentrated bet in the company that you work at, right? So
Also, some people will argue that, hey, it's because I know this company really well and I am bullish on this company and I understand this company the most. But I think the point here is that if you have to take a concentrated bet, like Nvidia, there are people out there in the US who do deep research on companies other than the companies that they're working at also.
Right.
And so great, if you have conviction anyway of putting this money. So say, for example, if your spouse is working at another company, do you have so much conviction in your own company that you will take her entire salary and buy this company's stock as well? If you do, great. Then I think it's okay to keep investing in your company as well. But if not, then right, build that conviction in other companies as well. Like go deep, understand the businesses, do the research and then do your thing. Nobody's stopping you. But yeah, I agree with you. Thank you, Vatsal, for sharing this data with us. For those of you who want your Excel sheets, go to Vatsal's link in the description in the comment. Okay, the next section is a framework on how you can think about concentration of wealth. A lot of you will come to me and be like, hey, we have concentrated wealth so far. It has worked out well, but I just still want to nudge you to think about this in this framework. And so hopefully you can make a more informed decision going forward. First, let's establish that we are trying to optimize our wealth towards achievement of life goals and not to become ultra wealthy, right? We are not optimizing for that. We want to achieve our life goals. And that is what this wealth is in service towards. Be it your kids' education, be it a retirement corpus or a house loan or like paying off your house loan, buying a house and so on, right? That is what we are optimizing towards. Now let's take an example. Say you are somebody who has 10 crores in net worth, out of which 4 crores are in your company stock. For this example, let's take Amazon, right? You have 10 crores of net worth, 4 crores of that is in Amazon, 6 crores are in other financial assets. The need for your life is about, for your financial goals is about 8 crores, which is say your house loan, your retirement corpus, kids' education, all of that combined is about 8 crores. And you have a net worth of 10 crores. So the way to think about this is that this 8 crores is what you need to safeguard. It is what you can't afford to lose for your peace of mind, because it is going to set you back a few years if you lose this money, right? So you diversify and protect this 8 crore rupees. You either invested in index funds or you invested in across multiple assets. I am not an investment advisor. I will not give you that advice, but essentially you protect it, right? That's how you think about it. The remaining 2 crores or out of your 10 crores is what your surplus is, which can basically be like your wealth maximizer. That this is the surplus that you take risk with. You can, because even if you lose this surplus, it's not like your goals are going to be set aside or you're going to be set back in time. Your life is not going to go haywire just because you've lost this 2 crores. And so you can take wealth maximizer bets depending on where your conviction is. And there are a bunch of ways to take these bets, concentration risk being one of them, right? So that's how you can think about it, that protect and safeguard the 8 crores to make sure that you do not lose that money and your goals are not suffering, and take wealth maximizer bets with the 2 crore surplus that you're left with. There are 3 ways in which you can take wealth maximizer bets at a high level. The first one is concentration bets, which is basically you invest that entire 2 crore amount in your Amazon stock. That is a concentration bet that you've taken, that if this does well, I do well. If this doesn't do well, it's okay. No love lost, because this was anyway surplus money. That's one way, concentration. The number 2 way is taking high beta bets, which is basically very high volatility, large upsides, large downsides. There is one stock like that called Iron, which has been going crazy. There are also cryptos which do this, where there's high volatility. So that is another way to take high beta bets, right? And the third way to do this is through leverage, where you basically borrow on the back of this money. So you have 2 crores and you can basically take leverage and buy stocks or buy assets worth say 4-5 crores, and then you take an outsized impact, outsized bet. That's the third way to take wealth maximizer bets. I do not want to suggest what way you should choose. That is entirely up to you, your risk appetite. I just wanted to give you this framework that try and break down your corpus into what is tied to your financial goals, what is surplus, and then take that decision that you want concentration in bets as a part of your surplus and not as a part of your main corpus, because you want to be protecting that corpus and not going back in time, because that can really mess with your mental peace and your financial well-being. Now, if you don't have answers to these questions, and I understand that a lot of you won't, because these are very hard questions to answer, you actually have to start with a goal-based approach. There are a lot of channels who talk about just free FinCal being the first one that started talking about this goal-based investing approach. I would highly recommend you get a financial planner. I can vouch for the folks at the Financialist. I have worked with them personally. They are fee-based, so they are not paid or incentivized by a mutual fund company or a life insurance company to sell you a product. They will take money from you, and therefore they are working in your best interest. They are backed by Zerodha. They have a multiple different tiers of pricing. These guys are really earnest, sincere, and smart. I always learn something from them when I work with them. I would highly encourage you to start thinking of this goal-based planning. Think of what your financial goals are. Tie this money back to that financial goal, and then take a decision of what to do with that money. That is my 2 cents on this topic. I personally will also share what I do with this money at the end of it. But if you want to try out Financialist, the link is in the description and in the pinned comments. You should go check it out, set up a call with them, and make the most of it. Now, coming to the last part, what have I been doing with my Google stock? No prizes for guessing. I have been selling at multiple different points in time. I don't want to divulge more details about that, but I have sold at different points in time because, like I said, I want to tie it back to goals and make sure that it's helping me achieve my goals and not just like maximizing wealth, right? That is a separate topic for a separate day. That brings us to the end of today's video. I hope you enjoyed that. It was a little different, this type of a video, but a lot of people have been thinking about selling their stocks, and I thought it would be timely to sort of share my thoughts and opinions and give you a framework to think about it. If you like that, consider subscribing to the channel. I'm trying to get to 100k subs, and so your support would mean a lot. I don't usually ask for subscribers, and I've noticed that like some 90% of my viewers of this channel don't actually subscribe to it. And so now I started asking that please subscribe to it if you find it valuable and help me get to 100k subs. With that, thank you and see you all in the next one. Bye.